What we have found is that in general, the longer you invest in the equity markets, you have a better chance of making a higher return compared to a bond investment or a fixed income investment, especially when you factor in inflation, because inflation is one of those things that eats away your returns. So equities tend to outperform bonds in an inflationary environment, which is similar to what we've had in Vietnam for the longest time. But for how long you invest really depends on your own time horizon and your own financial goals, as I talked about. When you look at starting your investment career, or career rather than career, I should say, starting your investment profile, the sooner you start, the better it is, especially if you have longer term goals like retirement. Because the sooner you start, the better off it is, the more money you can save, the more money you invest, the more returns you gain on that investment for a longer period of time.
Now, for the VCBF Tactical Balance Fund, you introduced the systematic investment plan, which was adopted from Franklin Templeton Investment. Can that systematic investment plan be applied for the VCBF Blue Chip Fund?
In short, yes, it can. And it will be applied for the VCBF Blue Chip Fund. We have a systematic investment plan for our Tactical Balanced Fund, and we are also having the same plan for the VCBF Blue Chip Fund. Now, what the systematic investment plan really does is it allows you as an investor to invest a fixed amount of dong per month in your fund of choice. So whether the markets are going up or whether they're going down, you are investing a fixed amount of money. So let's say that is $1 million dong, for example. You can invest as little as that. Every month you will put aside $1 million dong, and that will be used to invest in the fund that you've chosen. Now, the benefit of investing in a systematic investment plan, there's a couple of benefits. One is you have the power of what's called the power of compounding. So each month as you're putting in money, that money is earning money, earning a return on it. The next month when you put in, it is added to that. So each month you are earning a return on that, similar to what you would do in a bank deposit. The second is dong cost averaging. That's what we call it. Now that is a little tricky concept because, as I explained, you're investing a fixed amount of dong every month. So in the case where the market is going up, you will automatically buy fewer units because the NAV is higher. But when the market is going down, you will buy more units because the NAV is lower. Now, so what that means is on average, your holding cost will be much lower rather than if you were to invest in big chunks by yourself. So that dong cost averaging is a huge advantage when you look at it over a long period of time because it brings your average cost down. And as you bring your average cost down, obviously the return that you have is much higher. Lastly, and this is more specific for our investment plan, you'd have if you have set an investment plan or you've had a systematic investment plan in place for 12 months, there is a discount that you will receive on that investment.
Now, there's a case that may happen during the investment process. That is, the net asset value can come down to below the bought value. In that case, what's your advice? So they sell or buy the fund certificates.
Your question about should an investor buy when the NAV is going down? It is an important one because your natural tendency is to get nervous. So the question we always ask is, why is it going down? This is the same question we ask when the market is going down and our investments are going down. So as portfolio managers, we look at it and ask the same question. Why is it going down? Is it going down because people are panicking about something that is unrelated to the company? If that is the case, then it is a buying opportunity. If people are panicking because the overall economy is starting to slow down, then we have to ask the question, is this going to have a direct impact on our investment? If it is, then we have to reassess. If it isn't, then we look at it as a buying opportunity. But this is where I'd like to mention again, the systematic investment plan makes a huge difference. So you automatically are buying more when the market is going down, which is what you should be doing. Now, this also depends on your investment time horizon. If you've got a long-term investment time horizon, then the smart thing to do is to buy more. Because I'll give you a simple example. If you like something and it costs you 10,000 dong to buy it. Now suddenly the seller decides that instead of 10,000 dong, he is going to charge you 5,000 dong. Should you buy more of it or should you buy less of it? Now the way I look at it is, if you liked it at 10,000 dong, you should be willing to buy 2 of them at 5,000 dong, right? That's similar to the way you look at it when you're looking at investing. But the way to make sure you answer the question is, why has it gone down? In our case, let's say that 10,000 dong item that you wanted to buy, did it go down to 5,000 because it broke? Or did it go down to 5,000 because the seller needs to shut his shop and he wants to get rid of all his supplies? Now, if it's the second reason, then you want to buy as much of it as you can, because there is nothing wrong with the product and you liked it in the first place. So that is similar to the way we look at investing, and that is why a systematic investment plan makes it easier. Now I want to mention one thing. So Sir John Templeton, who set up the Templeton organization, had a very famous phrase that he would use. The maximum point of pessimism is the best time to buy, and the maximum point of optimism is the best time to sell. So put simply, when everybody is panicking and wanting to sell, is usually the best time to buy, because you're going to get deals on it. And similarly, when everybody is excited and everything is going up, is usually the best time to sell, because you can get the best price for it.
You know, risk is an inevitable factor when we invest into something. How can you help the investor minimize risk or even eliminate them?
You cannot eliminate risk. Risk is part of what we're dealing with. But what you can do is minimize it. So the way we minimize risk is we do a lot of research. And this is what I mentioned earlier, is the more research you do, the more you know about a particular investment. The more you know about a particular investment, the safer it will be. Now, is it likely that it can go down? Sure, it is possible it will go down. But the more research you do, the better prepared you are to handle that risk. So what we do is we do a lot of scenario analysis. So we try to imagine what would be a bad scenario. What could be a completely horrible outcome for a particular investment. Now, in a lot of cases, you can't imagine some of these things. For example, there was no way we could have imagined that China was going to decide to put an oil rig in Vietnam's waters. That is a risk you cannot assess. But what you could have done, and what we did, was in case you have a risk that you could not have seen, what is the direct impact on a given investment, and try to analyze that. So because we were able to do that, we had the conviction to step in and buy. So we do a lot of that. We do a lot of scenario analysis to see what is the risk that you can see, that you can understand. Now, on the flip side, on the scenario analysis, we also look at what is the best possible outcome for a company. So we don't want to just look at what is the worst possible thing. We also want to look at what is the best thing. So if the best thing happens, how long will it take for that to happen? Now, the reason we do the upside analysis also on the scenario is to make sure that we don't sell an investment too early. So if we think a company is worth 50,000 dong per share, and today it is trading at 30,000 dong. But in our upside analysis, that 50,000 dong was actually 100,000 dong. Now, if we had not done that analysis, if the company moved up to 50,000 dong, we would have sold it. Now, what we would have done then is left behind another 50,000 dong of appreciation. So what we want to do is make sure we analyze both sides of it, and then make an informed decision that this is what the value of the company is based on all these scenarios. So that's how we mitigate the risk. There are also a number of reports that we run internally to analyze risks that we may not realize we are taking. One of those things is concentration risk. So we might like a company a lot, and we might invest in it, and we might keep buying it. What we have to make sure that it doesn't become too big in the portfolio. Or similar companies. So let's say we like food and beverage as a sector. We like 1, 2, 3, 4 different companies in there. We shouldn't have too many of them in the portfolio. So we run internal reports to make sure that they analyze and tell us, okay, portfolio manager, you might like these companies, but on a whole, you have too much exposure in one particular sector. There's no such thing as, is it a good thing or a bad thing? It's more about making sure you know that. So if we know that we have so much exposure, then you have to ask the question, are we comfortable with that exposure, or do we want to reduce it and make it the right size?
And last but not least, other fund managers have launched the exchange-traded funds in Vietnam. What about the VCBF?
So exchange-traded funds, like you said, have received a lot of publicity recently. Exchange-traded funds, by definition, are a passive investment style. At VCBF, we are an active investment manager. So by definition, we are not likely to launch an exchange-traded fund. Exchange-traded funds invest in the index that they are mimicking. So, for example, if you're a VN index, exchange-traded fund, you are investing in everything that is in the VN index. So if the VN index is going up, you're going to benefit. If the VN index is going down, you're going to go down with it as well. With VCBF, the way we look at investing is purely on a bottom-up basis. And what that means is each individual company that we invest in, we thoroughly research. So let's say, for example, the markets are going down, like I mentioned earlier, we will ask the question, why? If the why has nothing to do with our underlying investments, then we will be able to buy more. So we have the ability to take advantage of a market panic. Whereas an exchange-traded fund, because of the structure and because it is a passive investment style, cannot necessarily take advantage of that. Now, there are different advantages of an exchange-traded fund, but from a VCBF perspective, we would only want to be active investors. And that means generating a return for our investors that is above the index. Whereas an exchange-traded fund will only generate a return in line with what the index does.
All right, and thank you so much for joining us today. Thank you for your informative talk today.
Thank you very much for having me. It has been a pleasure.
Thank you. Thưa quý vị, vừa rồi là những chia sẻ của ông Avinash Sakwaleka, Tổng Giám đốc kiêm Giám đốc đầu tư của VCBF về quỹ đầu tư cổ phiếu hàng đầu. Hy vọng quý vị có thể tìm ra cho mình một phương thức quản lý đồng tiền và đầu tư thông minh. Xin chào tạm biệt và hẹn gặp lại quý vị trong những chương trình sau.